Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. All right, ladies and gentlemen, there are moments in financial history when markets appear quiet, not because nothing is happening, but because the real activity has moved somewhere less visible. Not to trading screens, not to social media, not to headlines, but into infrastructure meetings, regulatory drafting rooms, and balance sheet planning sessions that most people never see or hear of. From a structural historical perspective, these moments often matter more than any short-term price movement. They mark transitions, when a system stops being experimental and starts being integrated. Ladies and gentlemen, before we go any further, I just want to thank everyone who likes, shares, subscribes, and comments on these videos. These simple things help us out a lot, and they continue to keep bringing these videos to a lot more people in the crypto community. I thank you very, very much. Today, much of the digital asset conversation is still framed around speculation, volatility, and cycles. Yet behind the surface narrative, there are signs that something deeper may be unfolding. A gradual shift from crypto as a speculative arena towards crypto as a settlement infrastructure. The shift is important, but widely misunderstood, not because of what it promises, but because of what it changes, about how the system functions. That's what we're going to explore today. Let's talk about the thesis and learning frame, ladies and gentlemen. The core thesis of today's discussion is simple, but nuanced. The digital asset ecosystem may be entering a phase where infrastructure and regulation matter more than speculation, and where institutional systems, not retail behavior, begin shaping the direction of development. This does not imply outcomes. It does not imply timelines. It does not imply guarantees. What it does imply is a change in emphasis. By the end of this video, you should have a clear understanding of why custody and settlement matter more than narratives, how institutions prepare for structural shifts long before they become visible, why regulatory delay can freeze progress without reversing it, and why patience and system-level thinking have historically separated noise from signal. This is not about forecasting markets, it's about understanding architecture. Let's talk about an in-depth analysis for a second. From speculation to settlement, in the early stages of any financial innovation, speculation dominates. We saw it with railroads in the 1800s, with telecom stocks in the 1900s, and with internet companies before regulatory frameworks existed. Speculation isn't a failure of a system, it's a phase. What matters? It's what comes next. Settlement systems are where real economies operate. They are slow, they are regulated, they're conservative. They are deeply risk-averse, and they only adopt new technology when it aligns with compliance custody and continually requirements. One useful analogy here is electricity. Before power grids were standardized, electricity was exciting, but unreliable. Once grids, regulations, and redundancy were built, electricity stopped being a novelty and became invisible infrastructure. From a structural perspective, digital assets appear to be approaching a similar transition. Let's talk about the quiet foundation, custody. Custody is not a retail topic, but it's the foundation of institutional finance. In traditional markets, assets do not move unless custody is ensured, regulated, and orderable. Period. From my time observing traditional financial markets, one lesson repeated itself constantly. Nothing scales until custody risk is neutralized. A bank doesn't ask whether an asset is innovative. It asks whether it can be safeguarded, insured, and reconciled. Reports suggesting that U.S. regulators are exploring standardized digital asset custody frameworks should be viewed through this lens, not as excitement, but as risk management. A useful real-world analogy is the evolution of money market funds. Before the regulatory guardrails, institutions avoided them. After standardized protections, they became core financial plumbing. Custody isn't about opportunity, it's about permission. Let's talk about Ripple, escrow, and institutional design. Ripple's architecture is often discussed emotionally, but structurally, it raises an important distinction. Many digital assets projects attempt to retrofit compliance after launch. Others appear designed with regulated environments in mind from the beginning. The discussion around escrow liquidity is a good example of how narratives diverge from institutional logic. In traditional finance, pre-allocated liquidity is common. Central banks Clearinghouses and settlement networks routinely earmark reserves long before public usage begins. Think of it like an airport runway. The runway is built years before passenger volume justifies it. The goal isn't immediate use, it's operational readiness based on public observation. Ripple's approach resembles this model more than a speculative treasury strategy. This doesn't imply outcomes, but it does explain design intent. Legislative fiction and regulatory time. Ladies and gentlemen, regulation does not move a market speed. From experience, one thing traditional finance taught me is this: regulatory delay is not rejection, it's a process. Financial legislation often misses windows, not because of disagreement, but because of timing and elections and political bandwidth. The Clarity Act discussion reflects this reality. When rules are delayed, institutions don't rush ahead. They pause. They prepare quietly. They wait. A helpful analogy here is building codes. Construction doesn't stop forever when codes are updated, but major projects often wait for clarity before proceeding. This creates a perception of stagnation, and even while groundwork continues behind the scenes, let's talk about retail fatigue and institutional silence. Retail participation tends to peak during narrative phases and retreat during infrastructure phases. This is not new. After the dot-com bubble burst, retail interest collapsed, yet during the period broadband, cloud infrastructure, and enterprise software quietly matured. What mattered wasn't timing, it was structure. Institutional involvement rarely announces itself loudly. It shows up in filings, staffing decisions, compliance budgets, and internal mandates. Silence is not absent often, it's preparation. Let's talk about resilience, redundancy, and systematic thinking. One of the least discussed advantages of distributed ledger systems is redundancy. In traditional payment systems, single points of failure are existential risks. Entire markets have halted due to one malfunctioning node. Distributed systems, by contrast, are designed around continuing. A useful analogy is aviation. Planes are not built to avoid failure. They're built to survive it. Redundancy is the future, not the flaw. For institutions managing systematic risk, this matters for more than speed or novelty. Let's talk about experience-based observations from traditional finance. I saw this pattern repeat long before it was obvious. New infrastructure is mocked first, then ignored, then quietly adopted. And in traditional finance, the loudest phase is usually the least important. The decisive phase is procedural and almost invisible. One thing experience taught me: markets reward understanding systems, not chasing narratives. Patience isn't passive, it's analytical. Let's talk about structural and institutional implications. From a long-term structural perspective, institutions respond to infrastructure shifts cautiously and incrementally. They test, they sandbox, they wait. Understanding incentives matter more than reacting to headlines. Institutions are not optimized for speed, they're optimized for survivability. That changes how progression looks from the outside, and progress from the outside as well. To bring this together, what we're observing is not a race and not a promise, but a reorientation from spectacle to systems, from speculation to settlement, from noise to infrastructure. The most important developments in finance rarely announce themselves dramatically. They unfold methodically through policy drafts, compliance frameworks, and operational planning. As history shows, understanding context matters more than reacting to momentum. Remember, the game is changing, and those who understand it first will benefit the most. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. Just open your eyes, smash that like button, ring the bell, leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic.